Taking a look at the overall market picture, I was saying earlier, the NSE seeing a bit of a turnaround on Friday. Retreats this year have been pretty shallow and short-lived, haven't they? So are we past the bottom in your view?
I am. We're in a very strong bull channel, which started sometime last year. We're about 3% off the 2010 highs. We're up about 29% in 2010. I think we've overtaken Nigeria now. So basically, I see it in a very strong bull channel. I continue to think that you need to buy this market, and I continue to see it higher. You know, these corrections are pretty vicious. They're about 100, 120 points at a time, no more than 3%. They don't look very good, but we tend to come out of them much higher each time.
There are overarching concerns, though. I mean, in GDP growth, the central bank, as I was saying earlier last week, reiterated that it's concerned about the strengthening of economic growth in the East African region, specifically in Kenya. So there is inherent risk that presents itself here.
Absolutely, and those risks are primarily, I think, domestic, part political. We've got the referendum not so far away now, and I think the market is poised for a yes vote. A no will I think, rattle the cage. And then we've got the election in 2012. And against that, you know, this rebound, which most people are projecting to be between 4 and 4.5% growth this year, is a halfway mark. We want to see substantial follow through. And the question is whether we'll see that. But at the moment, we're in a sweet spot, improving economy, low interest rates, and gaining some further traction with what were optimal rains.
For now, as you say, we've got lending rates stabilizing at these lower levels. Are we seeing significant enough progress being made by the banks in particular that we'd start to see this feed through to household borrowing and investment soon?
It's a very interesting question, and I think it's a challenge which is challenging the central bank governor at the same time. He continues to try and chivvy the banks along. I remain a little bit surprised that no bank has stepped out and gone aggressively after the household lending market. These rates have to come down. The repo rate's at 6 3/4. Lending rates remain stuck and stubborn around 15%. It's, you know, the spread is so wide, it's practically obscene. It's got to come narrower, and it will. I'm just surprised no one has stepped up yet.
As we heard in the news, I mean, lots of Kenya's banks at the moment making headlines today. Let's look at the banking segment of the market, because the big cap stocks are highly correlated to GDP, lending rates falling lower as well. What's your views on these players at the moment in the market? And we're talking very broadly here.
Sure, they've been the recent outperformers in the last 4 to 6 weeks. Buyers have been snapping up shares like Co-op Bank, which you just mentioned, which is now trading at an all-time high. Equity Bank surged, albeit for some profit taking at the end of last week, but is at levels not seen for 2 years. And Standard Chartered is somewhere near 3.5-year highs. So we've had a tremendous interest in this sector. The PEs on a trailing basis are about 14 and 13, on a forward basis about 11. But I think this set of these 5 banks look to me quite attractive, and I don't see much downside risk at the moment. This spilled over a little bit into the second-tier banks like Diamond Trust, which traded 3.68% of its shares on Friday.